Welcome to the deep dive. Our mission here is pretty straightforward. You send us sources, and we pull out the key knowledge for you.
That's right.
Today, we're diving into something that's definitely causing some anxiety, the possibility of another financial crisis, and we're specifically looking at the housing market through the lens of Peter Schiff.
Right. We're using a recent YouTube video featuring him. And Schiff, well, he's known for having called the 2008 crisis, which adds a certain weight.
It definitely does, and his core message in this video is pretty stark.
Mm.
He thinks the situation now could potentially be, and I quote, worse than 2008.
Which immediately makes you sit up and ask, okay, why? What's the reasoning? He's not just rehashing 2008. He sees parallels, sure, but also critical differences this time around.
Exactly. The video really zooms in on two main things, yeah.
Mhm.
First, the big picture, sovereign debt, currencies, inflation. And second, what he calls the totally messed up housing market.
Yeah, they're connected in his view.
Okay, so let's jump right in. This looming crisis idea. What are these echoes of 2008 he's talking about? And how are things, bigger or different now?
Well, Schiff's argument is basically that the fundamental problems, the imbalances that led to '08, they were never really fixed. In fact, he thinks they've gotten worse, much bigger in scale.
Hmm.
He's very clear this isn't some random black swan event nobody saw coming. He calls it a white swan, something predictable given the conditions.
A white swan.
Yeah.
Okay, so predictable. What's the key difference then compared to last time?
The big shift, he argues, is from a crisis mostly rooted in housing and mortgages, like in '08, to something broader, a potential sovereign debt crisis, and related to that, a currency crisis.
Sovereign debt and currency. Okay.
Yeah.
That definitely sounds like a much larger scale problem than just housing. So how does he see that playing out? Like, what's the chain reaction from government debt?
You look at the sheer amount of debt governments, especially the U.S., have taken on. Schiff's concern is that it's just not sustainable. So his argument goes, if governments can't pay their debts through taxes or growth, the central banks, like the Fed here, might step in and, well, essentially print money to cover the bills.
Monetizing the debt, basically.
Exactly. And when you increase the money supply like that, without a matching increase in actual stuff, goods, and services, you get inflation. Your money buys less. He even talks about the possibility of much higher inflation, maybe even hyperinflation down the road.
Okay, so that ties directly into, the rising costs people are already feeling every day.
Precisely. It's not just an abstract economic theory. It hits your wallet.
All right, let's pivot then to the housing market, which he clearly has strong feelings about, calling it totally screwed up. What's the root cause there, according to him?
He takes a long view. He argues that for decades, government policies, things like mortgage subsidies, guarantees, have artificially pushed up home prices.
So, trying to make homeownership easier, but with side effects.
Yeah, that's his take. He believes these policies encouraged looser lending, letting people buy who maybe weren't financially ready, which highlights that tension, good intentions maybe, but potential long-term market distortions. He thinks the whole system became fragile because of it.
And he mentioned this also tilted what kind of housing got built, right?
That's right. The incentives favored single-family homes over, say, apartments. Then you jump to the pandemic. The Fed cut rates to basically zero.
Which led to those crazy low mortgage rates.
Absolutely. Historically low. And naturally, millions of homeowners refinanced, locking in those rates.
Ah, okay. And that's created this locked-in effect he talks about now. People don't want to move.
Exactly. That's a huge factor now. If you have a 3% mortgage, why sell and buy again with a rate maybe around 7 or 8%? It's a massive financial disincentive.
So that keeps inventory low.
Very low. And it creates another problem Schiff points out for the banks. Even if people are paying those low-rate mortgages on time, the loans themselves are less valuable to the bank now because the interest they earn is so much lower than current rates, like the Fed funds rate.
Right. He mentioned banks pretending they're not insolvent by not marking to market. That sounds serious.
It is a significant point. Marking to market means valuing assets at today's price. Schiff says banks are using accounting rules that let them assume they'll hold these mortgages and bonds until maturity, so they don't have to report the loss in current market value right now.
But the loss is real if they needed to sell them, or if depositors wanted their money.
Precisely. That's the risk he highlights. If confidence wavers and people want their cash, the banks might have to sell those assets at a loss. So, switching back to the market today. It's strange, right? Rates jump from, say, 3% to near 8%, but home prices haven't really collapsed overall. Why do you think that is?
Well, it seems to come back to that low inventory, doesn't it? But locked-in owners aren't selling, and maybe builders are slowing down too because costs are up.
That's exactly it. High material costs, labor costs. It's expensive to build new homes right now, too. So you have constrained supply meeting still present demand, even with higher rates.
So for someone listening, maybe thinking about buying, Schiff's take doesn't sound too optimistic for buyers right now.
No, his general feeling in the video is that for many people, renting might actually be the smarter financial move right now. It really depends on your situation, your location, obviously, but it definitely pushes back on the always buy mentality.
Which brings up the whole rent versus buy debate. And you talked about government policies tilting that scale, too.
Yeah, things like the mortgage interest deduction historically favored owning.
Right.
Although it's worth noting, the big increase in the standard deduction a few years back means fewer people actually itemize now, so that specific tax break isn't as powerful as it once was for many.
Ah, good point.
But still, you've got that powerful incentive for existing owners with those super low rates to just stay put, even if renting might look cheaper month to month on paper.
And owning has other costs that are going up, too, right? Not just the mortgage.
Absolutely. He touches on that property taxes, insurance premiums, maintenance, those are all climbing and add to the real cost of ownership. Rents are up too, of course, in many places, but renting generally avoids those big, unpredictable repair bills and high upfront costs.
The YouTube host in the video even shared his own story, didn't he? About buying with a low rate.
Yeah, it was a good illustration. He showed how much higher his payment would be today versus the rate he locked in, which just hammers home why he wouldn't sell unless he absolutely had to.
And he brought up an interesting point about maybe not paying off that cheap mortgage early.
Yeah, why rush to pay off a 3% loan when you could potentially invest that extra money and maybe earn, 5% or more elsewhere? Financially, in this environment, keeping the cheap debt might make sense.
Which kind of leads into this bigger question about the whole American dream being tied to homeownership.
Yeah.
Schiff, or at least the commentary around him, seems critical of that link.
Yes, the idea presented is that maybe the real estate industry sort of helped shape this narrative that owning a house is the only or the best way to build wealth and achieve security.
But it's not always a straightforward investment.
Right. You have to factor in all those costs we mentioned, maintenance, taxes, insurance, transaction costs when you sell. And a lot of the price appreciation people see over long periods might just be inflation, not a real increase in value.
He mentions the teardown idea, too.
Yeah, the concept that eventually the physical structure, the house itself, might depreciate to zero value, and only the land underneath holds the real worth. It's a provocative way to think about it.
He also looked at historical returns, right?
Mm-hmm.
Comparing housing appreciation after inflation to something like the stock market.
He did, suggesting that historically, maybe housing only appreciated, say, 1-3% above inflation long term, while other investments like the S&P 500 might have offered significantly higher returns, though obviously with different risks.
So the advice back in the last bubble, if renting is cheaper, rent and invest the difference. He seems to still endorse that logic.
It seems so. And he adds another layer by questioning the official inflation numbers, the CPI.
Saying it understates real cost increases.
Yeah, his argument is that the true cost of living has gone up much more than the official stats suggest. And he often uses gold as a benchmark, pointing out how much the dollar has devalued against gold since, say, the Fed was created.
So if you measure house prices in, like, ounces of gold instead of dollars.
Exactly. His point is that measured against a more stable store of value like gold, maybe house prices haven't actually gone up nearly as much as the dollar figures suggest over the very long term.
Okay, so wrapping all these arguments together, what's his prediction for the housing market going forward? Prices crashing.
He does think we could see a nominal price drops the actual dollar price in some specific markets, but his stronger belief seems to be in continued significant inflation.
So inflation might keep the nominal prices from falling too much overall.
That seems to be his reasoning. High inflation makes it harder for nominal prices to fall across the board. But, and this is key, he predicts a crash in real terms.
Meaning, compared to other things?
Yes. The price of a house relative to everyday costs, like groceries, or relative to assets like gold. He thinks houses will become much more expensive in terms of how much real stuff you have to give up to buy one.
So the sticker price might not plummet everywhere, but your purchasing power towards buying a house effectively does. It takes way more work or other assets to afford one.
That's the idea. A crash in affordability, a crash in value relative to fundamentals, even if the nominal dollar price stays sticky or only dips modestly in some areas.
Okay, so let's try and sum this up. Based on Schiff's analysis in this video, We're looking at a potential financial crunch, maybe bigger than '08, fueled by debt and currency issues, not just housing this time.
Right.
And the housing market itself is distorted by past interventions, now stuck with low inventory due to locked-in rates, and facing rising ownership costs alongside high prices.
And he's definitely skeptical about homeownership being the automatic best investment, suggesting renting might be smarter for many right now.
It certainly challenges the conventional wisdom.
It does, and that leaves us, and you listening, with a pretty big question to chew on. Given all this, how do you approach your own finances? How do you figure out what things are really worth in an environment where inflation might be significantly eroding the value of currency? What does financial security even look like in this kind of world?
Hmm. Definitely some heavy things to think about.